Mastering tax negotiation strategies with the IRS. Navigating tax debt can be a daunting experience, especially when dealing with the IRS. Many taxpayers find themselves overwhelmed by the complexities of tax negotiations, unsure of their options or how to approach the situation. I'm a CPA, qualified to represent taxpayers in any of the 50 states before the Internal Revenue Service. I'm an expert level researcher, writer, and negotiator. I have been an auditor. Let's go over the 5 steps in the IRS collection process first. The assessment of tax is the legal starting point. Tax is assessed after a filed return, a self-assessment, or an auditor exam, or a substitute for return, or a default after a statutory notice of deficiency. This assessment creates an enforceable debt. No collection can begin until assessment occurs. 2. Notice and demand for payment. This is required by law. The IRS sends a notice and demand, often a CP-14. It states the amount due, penalties, and interest. Payment is due within 10 days, and failure to pay triggers the collection cycle. The third step is automated collection notices. These are progressively stronger notices. The typical sequence is a CP-501, balance due reminder, a CP-503, an urgent notice, a CP-504, an intent to levy state refunds, and a notice of your lien rights. Now, at this stage, enforced collection has not yet begun, but lien rights arise. Finally, number 4, filing of a federal tax lien. If unresolved, the IRS may file a notice of federal tax lien. It protects the government's interest in taxpayer assets, is public record, can impact your credit, and you do have collection due process rights, CDP rights, if timely requested. A lien does not seize the property, it secures the debt. Finally, levy or enforce collection, the most serious step. The IRS must issue a final notice of intent to levy, a letter 11 or letter 1058. After 30 days or a waiver, the IRS may levy bank accounts, garnish wages, seize certain assets. This is rare but possible. And CDP rights apply if requested timely. This is the actual asset seizure. Now, most cases are resolved before the final step, often at steps 3 or 4, using installment agreements, currently not collectible, offers in compromise, audit reconsideration if the assessment is wrong, or CDP hearings, collection due process hearings. A statutory notice of deficiency, often called a 90-day letter, a 3219A, is the IRS's formal legal notice that it has determined a tax deficiency and intends to assess additional tax unless the taxpayer timely challenges it. It's one of the most important documents the IRS issues. It's sent by certified mail to the last known address. It states the IRS's proposed changes, tax, penalties, and interest. But notice no assessment has occurred yet. This notice preserves the taxpayer's right to go to tax court before paying. The 90-day deadline is critical. The taxpayer has 90 days from the mailing date. The deadline is jurisdictional. Filing even 1 day late deprives tax court of jurisdiction. Once you're in tax court, you are protected from IRS collection until a decision is rendered. And if no petition is filed, the IRS will assess the tax and begin collection. Now, what happens after a statutory notice of deficiency is issued? If you file a tax court petition, the IRS cannot assess or collect. The case proceeds in U.S. tax court. Many cases are resolved before trial. They're stipulated or dismissed. In fact, in a recent year, I think it was 2024, 99.2% of the cases docketed for tax court trial were either dismissed or settled prior to trial. This is a very interesting statistic. If the taxpayer does not file a petition to tax court after receiving a 90-day statutory notice of deficiency letter, the IRS assesses the tax after day 90. The collection process begins, and your remedies would shift to audit reconsideration, appeals, or a refund claim where you pay first. Now, when the IRS issues a statutory notice of deficiency, common triggers include unagreed audit results, CP 2000 unresolved cases, substitute for return assessments, defaulted correspondence exams, or failure to respond to prior notices. A statutory notice of deficiency is not a bill, it's not a levy or lien, it's not an audit request, and it's not proof that the IRS is correct. It is a procedural gateway document. Common issues we run into are incorrect address, invalid notices, multiple notices for the same year, statute of limitations concerns, and penalty approval issues. So the statutory notice of deficiency is often the last best opportunity to stop assessment, force IRS review, or resolve the case without payment. Failure to act within 90 days shifts the taxpayer into collection defense mode, which is usually more expensive and limited. Now, remember, the IRS is not solely focused on collecting every dollar owed. Their primary goals are compliance and payment. They prefer to work with taxpayers who demonstrate a willingness to resolve their debts rather than resorting to aggressive collection. Pursuing aggressive collection actions, such as wage garnishments or bank levies, is costly and time-consuming from the IRS. Therefore, they're often open to negotiating payment plans or settlements. When negotiating with the IRS, accurate and organized documentation is essential. The IRS offers a variety of avenues for taxpayers to negotiate their debts. There are installment agreements, one of the most common methods. If you owe $50,000 or less, you may qualify for what's called a streamlined installment agreement. If you owe more, it's more complex. There's an offer in compromise. This is a settlement option that allows taxpayers to negotiate a reduced amount to settle their tax debt. However, qualifying for an OIC can be challenging, as the IRS has strict criteria regarding income, expenses, and asset equity. There's currently not collectible status. If you're currently experiencing significant financial hardship, you may qualify for this status. This temporarily halts collection actions. You'll need to provide the IRS with detailed information about your financial situation, income, expenses, and relevant documentation. And then they spend months and months reviewing your case and eventually determine whether you qualify for this status. This status, by the way, is temporary, even if you qualify for it. And then there's audit reconsideration. This is an IRS administrative process that allows the taxpayer to ask the IRS to re-examine the results of a completed audit when you disagree with the assessment, and if you have new information or if you've never had a real opportunity to present your case. It's commonly used after an audit has closed and the IRS has assessed additional tax. You can request it if the IRS has already completed an audit, additional tax was assessed, you disagree with the assessment, and you have new documentation, and the tax has not been fully paid. So, the most common use of audit reconsideration is when the assessment comes from an exam following a CP 2000 or default audit. Audit reconsideration is not an appeal. There's no appeals officer involved. It's not tax court. It doesn't stop collection automatically, and it's discretionary. The IRS can deny the request. And there's 4, 5, 6 steps to request audit consideration. Processing can take quite a while, at a minimum, quite a few months. The IRS may fully reverse the assessment, partially reduce it, or uphold the original assessment. And if denied, you may pay and file a refund claim. You may pursue appeals if available, or seek tax court if a statutory notice is reissued. As I stated before, I'm a professional, so I've stated facts for your consideration. The IRS is a complex organization. The Internal Revenue Code is quite extensive. The Internal Revenue Code and Treasury regulations are 18 to 22,000 pages. Treasury regulations, 26 Code of Federal Regulations, expand and interpret the code and are often many times longer than the statute they interpret. If you include the Internal Revenue Code, Treasury regulations, IRS revenue rulings, notices, forms, and court decisions, you're easily looking at 70,000 pages of authoritative tax material. And that number grows every year. The Internal Revenue Code and regulations are about 20,000 pages, and the practical tax law universe is about 50,000 pages. Now, this matters because the code itself is relatively compact, and most taxpayer rights and obligations come from interpretation. Many disputes hinge on regulatory overreach, missing procedural steps. This is why procedural defenses to the Statutory Notice of Deficiency, validity assessment, timing, CDP rights, audit reconsideration are so powerful. This is what I specialize in and what I handle very brilliantly and very expertly. Check out my website, Tax Options LLC. Send me an email. I can send you a detailed CV with my personal phone number, address, and personal contact information too. Have a good day.